Hi, this is Jack Canfield, and welcome back to another segment of Talking About Success. My guest today has flown over here all the way from Australia, where he is an expert on financial matters. We're going to talk about that. He's written a book which we could call a blueprint on do-it-yourself investing. We're going to talk about why you want to do it yourself, and I think it's some very interesting points to make today. I think you're going to walk away from this show today and you're going to have a lot more insight into this whole world of investing, whether you're already in it. I think there's some misconceptions and some myths you're going to find out about that are going to be helpful. I also think if you're not involved in investing, you're going to find out why you should be. And we're going to talk about that as well. So you've been on television in Australia, you've been a financial expert, you've been someone who's helped lots and lots and lots of people make a lot of money and avoid losing money. You've been an investor yourself and you're an investment educator.
Yes.
Very good. Welcome to my show.
Oh, thank you very much, Jack. Thanks for having me here.
Now, you talk about the importance of investing and the importance of having a retirement and the importance of if you don't do this correctly, you're going to lose about $2 million that you needed to have when you got to be 65. So you talk about different ages and how much money most people have in their retirement accounts and why that's not necessarily a good thing.
Yes.
So I want you to talk about that. It's very fascinating.
Okay, well, first thing I think people need to realize is that everybody is an investor, and they're an investor through their retirement saving. And these, I know in the United States it's not compulsory, but you have to put money, or it's not mandatory, but you should be putting money, and just about everybody is these days, is putting money into their 401ks or an IRA. And through that you become an investor. But what most people do is they tick a box that gets presented to them when they start a new job, and that box ensures that their money goes into a balanced fund or a target date fund or a diversified fund of some sort. And what has been proven by a company called McGraw-Hill, a company called Standard & Poor Dow Jones Indices, they've got a scorecard that they keep. And that scorecard shows that basically after 5 or 6 years that nearly 100%, 99 point something, funds, active mutual funds, underperform the stock market indices. And it's the diversification away from the stock market into other lower performing asset classes such as bonds and real estate that actually puts a handbrake on their retirement funds. So if you have somebody in their 20s or 30s or 40s or even 50s that's had a handbrake on their retirement fund for all those years, they're going to lose out on lots of compounding over many years. And that's what turns into many hundreds of thousands, even up to $1 or $2 million.
So you talked about how you could literally be $230,000 shorter than you need to be if you started in your 40s when you reach 65 or whatever retirement age you decide to quit at. Talk about that for a moment.
Well, if you take somebody who's 45, now the average, a 45-year-old has an average amount of about $109,000 in their 401k or the IRA in the United States, and it's about $150,000 for somebody in their 50s. So a 45-year-old today, roughly about 20 years or 25 years to retirement, if they go through a financial advisor of some sort, they're going to be paying typically about 1% away in additional fees through the financial advisor and the mutual funds that they go into. Now that 1% for somebody who's 45 years old, assuming that they put the $18,000 a year into their IRA or 401k, and then when they get to 50, $24,000, that 1% turns into lost money to the tune of, through loss of compounding, to the tune of $230,000. Just that 1% per annum over 20 years.
So if I should have 2 million, I'm going to have like 17,500,000, something like that.
That's what it is.
1.75.
Well, and that's just in the fees component. But if you then take the positive side of it, where not only do you get that money working for you to the tune of $230,000 over 20 years,
it's also
you're also not in a diversified fund, which means that you got all your money exposed to the stock market in a index fund, in a listed mutual fund, if you like, and that does far better than the balanced funds and the diversified funds. And particularly the target date funds. The target date funds do the worst, but they have the greatest growth in people that are going into putting their money into 401ks at the moment. Why? Well, because the financial fraternity love that, because that's how they justify their fees.
That's how they justify their fees.
They're doing all this work for you, but in the meanwhile they're putting a handbrake on.
But historically, according to the research you were telling me about, that the index funds outperform 99% of the
Absolutely.
managed funds.
Absolutely. And that research is coming from Standard & Poor Dow Jones Indices, who are the managers of the indices. So they do this research. They every 6 months they do 2,800 funds, active funds in the United States. And they do it against the S&P 500 and all the different indices. And they do it over 1 year, 3 years, 5 years, and 10 years. And the average of those is 85% underperform. And it's not the same 15% that do outperform. So they've got another scorecard they call the persistence scorecard, which actually shows that over 5 years, that gets down to 2 or 3 funds over 5 years that are actually not outperforming, matching the index, let alone outperforming.
Amazing.
It is.
Truly
absolutely,
amazing.
Absolutely. So that's what I want to divulge and show people how to do better, how to save on the fees, but also how to get their money working far better for them. So it's the power of compounding. And as Albert Einstein said, it's the 8th wonder of the world.
Yeah, I remember that quote. Yeah. So a lot of people, and me included, at least for most part of my life, would have said, I'm too busy to be researching all this stuff and doing my own investing in the stock market. And what do you say to that person?
Well, the first thing is, for most people, they see their house as their biggest investment. And typically that's how somebody who can do a better interest rate on your home loan would say it's your biggest investment. Whereas if they really think about it, their retirement, who they choose to invest their retirement money with is a far bigger decision they make. And that's because of the potential loss in compounding over 10, 20, 30, 40 years. My daughter is now following the strategy. She's 27 years old. She's going to sit in an index fund until she's wants to take an interest in doing her own timing and looking at it in a bit more detail. But she's going to be hundreds of thousands of dollars off, potentially even millions of dollars off, better off by the time she gets to retirement, starting with just a little bit, just of $10,000.
So you said that your daughter, until she gets to the time when she wants to start managing it in some way,
yes.
When is that and why?
Well, I would love her to take interest immediately, but I'm a realist and understand that at 27 she's doing other stuff with her money and her life, and she's doing parties and working hard and all that sort of thing. But at some stage I'd like her to do what my customers do, and what they do is they actually employ some very simple timing, where we have done tons of research. I've done thousands and thousands of hours of researching how the stock market moves, particularly indices and stocks as well, but here we're talking about indices. And what we will do is we will ensure that we don't sit through a big fall in the market, a big bear market. And we do that by researching the criteria that come into play just before the market really starts falling into a severe bear market. We don't know which one's going to be a severe bear market, but whichever one looks like it could be, we go into cash. So we do diversify 100% into cash, but only when we are called to do so. And the rest of the time we're 100% in the stock market, which is the best performing asset class of all the asset classes, proven over 200 or 300 years now. And so we'll be in the stock market, which is the best performing, when it's good to be, and then we'll be out when there could potentially be a bear market. Now, not every turn down turns into a severe bear market, so we will then time to get back in if it turns around and goes up. By doing that, you can get between 5 and 6% more per annum in returns over, if you take that into 20, 30, 40 years, even 10 years, and that turns into many more hundreds of thousands of dollars in returns as well. So it's not only the saving on the fees, it's also the potential better returns you can get by not being through those big bear markets.
Oh, that's significant.
It's huge. We're talking about a lot of money. It's a lot more than a decision on a house.
Right, I get it. Yeah. So I mentioned in the introduction that you have what I call a blueprint in terms of how to do it yourself investing, and talk about this blueprint.
Well, the blueprint, the very simple way of doing it would just be to buy and hold an index. And you wouldn't need to come to me for that. You could do that yourself. And you do that via an exchange-traded fund or a listed mutual fund, if you like, that is 100% invested in the index. However, if you wanted to get the additional 5 to 6% where you actually do the index timing.
And why wouldn't you?
Well, why wouldn't you? The only reason people wouldn't do it is because of time. And so the blueprint that we've put, complexity and time, the perceived complexity and the perceived amount of time that it would take up of their lives. Well, the blueprint that we've mapped out is that it could take, or it shouldn't take any more than 15 minutes a week to do this. If
15 minutes a week.
15 minutes a week. If you're doing more than 15 minutes a week, then I tell people they're actually doing research rather than following the system, right?
Right.
And the blueprint is a systemized, mechanical, non-discretionary, rules-based process where you just follow the recipe of getting in when you need to and getting out when the signals tell you. So it's green and red signals on a chart of the particular index. And you do that on average 2.5 times a year. That's the effort that it requires.
Wow, that'll really wear you out, right?
Well, people have to give up. It's as much time as it takes brushing your teeth every week.
I know. So secure your retirement for 15 minutes a week. That's a pretty good deal.
Well, hopefully, and we want to take that out and show people that they can do a lot better than what they're currently doing.
Very good. Yeah. So people want to find out about your book, about your blueprint, about your system, about you as a consultant, your company. How do they do that?
They can go to sharewealthsystems.com.
Sharewealthsystems.com. Very good.
Yeah.
Well, you're delightful. I wish we had more time to talk. I just like how happy you seem to be.
Oh, it's a joy what I do, Jack. I really do love it. In fact, can I tell one more story?
Sure, please.
Well, I was at a 50th birthday party just a couple of weeks ago, and the host is somebody who is I've known for some years. He's got a business. He's a businessman, and he's grown it quite dramatically. And we started talking about exit plans. And he asked me, "Do you have an exit plan?" And I said, "No, I don't." He said, "Well, why not?" So I said, "Well, I like what I do." So I said, "Well, why do you ask?" He said, "Well, I've got an exit plan. I want to get out fairly soon." So he said, "Well, you should have an exit plan. Everybody says you should." And I said, "Well," and I started thinking about it. He said, I said, "If I sold my business, I'll just carry on doing what I'm doing anyway." So he said, "Oh, that's a point." And that's I guess why it's a joy to keep on doing what I'm doing.
Well, I don't ever want to work with someone who doesn't love what they're doing, because I know that I love what I'm doing. People say, "When are you going to retire?" I'm never going to retire. I love doing what I do. But what I do, sit around and watch reruns of old TV shows. I don't think so. So anyway, I love having you as a guest. Thank you for joining me today.
Thank you very much,
And
Jack.
if you want to get this information that he has, which I find really fascinating because we've talked at much great length and we have the time to talk about right now, make sure you go to his website and check it out, get his book, work with him. I think you'll find it to be very valuable. And wish we had more time. We don't. You guys stay tuned. We'll be back right after this message.